There will be mass unemployment. I'm your host, Steve Van Metre, and thanks for joining me today. The Fed is about to reset the labor market, and you're going to see why. This could put millions of people out of work. Let's over to CNBC, where we picked today's story up with the headline, U.S. payroll surged by 261,000 in October, better than expected as hiring remains strong for now. Non-farm payrolls grew by 261,000 for the month, while the unemployment rate moved higher to 3.7%, according to the Labor Department. Although the number was better than expected, it still marked the slowest pace of job gains since December 2020. Now, what's interesting here is we just heard from some members of Congress, the Senate Banking Committee, and what did they do? They told Powell, you better not sacrifice the labor market. You better focus on making sure people stay at work. And what does Powell turn around and do? And you gotta love this. He says, hey, have some lag data from the Labor Department. This is, look, there's plenty of hirings. In fact, even better, we revised the previous month up, so there was even more jobs created than we thought. And so I think this is absolutely brilliant how the Fed just skates right through this once again, using the government's own lag data to pacify Congress. And it's just, to me, quite hilarious. Let's continue on, because we can see that the Fed does have an impact on the jobs market. I want to look at this chart first and then explain to you why that happens. And so what we're looking at is the total non-farm payroll report on a year-over-year rate of change in blue, and against that is the federal funds rate. So I want you to see that spikes in the funds rate, the red line going up, lead to a deceleration in the blue line. And we can see that happening over and over again, that anytime the Fed aggressively raises rates, that you get to the point where there's a deceleration in the jobs market that begins to happen, and we're seeing that now. Now, the idea that, of course, the Fed can create jobs is no more ridiculous than the fact that the Fed can destroy jobs. What the Fed does by raising rates is change how people spend their money. They move aggregate demand forward by lowering rates and push it back by raising rates. So if we think about now, we have credit card debt back at all-time highs. We've seen aggressive rate hikes. And what does this translate to as we go into the holidays is people are going to get their credit card bills. They're going to see that their minimum payments going up. They're going to see the interest rates going up. And they're going to look ahead into the news and say, wait a minute, the Fed says not only did they just raise rates again, and that's going to impact me in a couple months, but they said they're going to keep doing it. And it's that change in sentiment where they go from a spender to a person that says, hey, I need to pay down this debt because I cannot continue to afford higher and higher payments. And that's what changes, is their spending habits. That's what the Fed has control over, nothing else. Average hourly earnings grew 4.7% from a year ago and 0.4% for the month. So perhaps some good news for the labor market, those who are working against inflation, but not so quick. It says that wage growth is still likely to serve as price pressure as workers' pay, get this, is still well short of inflation. The yearly growth met expectations, while the monthly gain was slightly ahead of the 0.3% estimate. And we know for a fact that it's not keeping up with inflation because I put this chart together where I took this consumer price index and I subtracted off average hourly earnings, and we can note that any period where you see the red line above the black line, it means inflation is running faster than wage growth. We can see that commonly occurs and happens as you go into a recession. And notably, we can see here again, of course, as we know, you're hearing in the news, people are getting raises, but you're not hearing them say, hey, so glad I got that raise because it took the pressure off. They're getting the raise and turning around and saying it's still not enough. We can see that in this chart. It isn't. But that doesn't mean that wages are going to continue to accelerate. In fact, they're going to start to come down, maybe not in terms of go negative from where they are now, but the pace of their growth is going to slow. Here we can see in this chart that we're looked at yesterday, the non-farm business sector, we talk about unit labor costs. And of course, one of the biggest factors in unit labor cost is wages. Not, of course, we also have benefits and other factors. But notice now, yesterday we looked at the consumer price index. Now we'll look at average hourly earnings, and we can see that average hourly earnings are coming down, and that's leading unit labor costs lower, both on a year-over-year rate of change. And we noted yesterday that when this happens, it usually signals that there's a peak of inflation coming. Because why is that? Well, when workers don't have the wage increases, again, they don't spend as much, inflation starts to come down. But there's also a secondary factor we want to look at. And again, back to yesterday's charts, This time, we've got the labor productivity or output per hour. And we noted yesterday, what happens is when you hire people, they're not very productive. But the longer they're on the job, the more productive they are. So what we're seeing right now with the blue line is one of the lowest points in productivity in decades. And as people become more productive, guess what? Employers, their costs, their wages don't accelerate as fast. They don't need to give them as big raises to keep them around, because now instead of doing the work of, say, maybe half of a person when they were hired, they're now doing the work of 1 to 2 people, and that's what employers want, is productive employees. You don't have to give them as big raises, and you don't need as many other employees. You can trim off some of the unproductive ones, and that's a factor here too. The unemployment rate rose 0.2 percentage points, even though the labor force participation rate declined by 0.1 of a point to 62.2%. An alternative measure in unemployment, which includes discouraged workers and those holding part-time jobs for economic reasons, also edged higher to 6.8%. So now we're seeing people start to take on multiple jobs, but to the Fed's conundrum, which seems to be a recurring issue, is they can't figure out why higher wages aren't bringing more people into the labor market. It's not happening yet, but notably that does tend to occur during a recession as people come back into the labor market. But what the problem for the Fed perhaps is, they're showing all these job openings, and yet, as we'll look at here shortly, there aren't enough jobs to fill the vacancies of all these unemployed workers. They're struggling to find work. So something's not adding up here. But what we can note in the data is it doesn't make sense, but that we already knew. September's job numbers were revised higher to 315,000. Again, a pushback to Congress saying, look, the labor market's strong. We can keep raising rates, an increase of 52,000 from the original estimate. August went down by 23,000, still a net gain over the 3-month period. But Tom Porcelli, the chief U.S. economist at RBC Capital Markets, will say one of the people that's got it right, said the broader picture is of a slowly deteriorating labor market. The thing, it doesn't fall off a cliff. He said it's a grind into a slower backdrop. It works this way every time. So the fact that people want to hang their hat on this lagging indicator, again, referring to the non-farm payroll report, to determine where we're going is sort of laughable. And he's making fun of the Fed. And I think that's the point we're trying to make here in today's show, is that as we head into the holiday season, what do we have? Record inventories at the wholesale level, at the retail level. And what do we need people to do? Buy all that inventory, clear it out. But the Fed, due to their higher interest rates, are making it such that people do not have the money to spend. They're going to look at their credit cards. They're going to make a decision probably to spend less, and that's going to have an impact. And in turn, as I think we get into later part of December, we're going to see an increase in layoffs. And then going into next year, as all the seasonal people are headed back to the unemployment line, these payroll reports are going to look a whole lot different. And one thing we can do to say that there's some evidence to support that, if we look at the weekly unemployment claims, we note they remain very low in the low 200,000. We see here last week at 217,000, showing what appears to be a robust labor market. What it tells us, employers are generally hanging on to employees right now. But the challenge, and this is where I think we're starting to see some problems, as we look at continuing claims here, they're just under 1.5 million. But the Fed pointed out yesterday that there's about 1.9 jobs for every unemployed worker. The question then is, why is this number so high, and why is it rising at a clip now 47,000 last week, indicating that people on the unemployment line are struggling to find jobs? And I think that's a picture we're starting to show here, is the economy is much weaker than the Fed expects. And as we head again into the holiday season, even retailers now are starting to panic. Inflation to dampen holiday spending, retail trade group forecasts, as the National Retail Federation said Thursday, it expects holiday sales during November, December to rise between 6 to 8% from last year, which headline sounds great, but a decline when factoring the effects of inflation. A sales forecast excludes spending at automotive dealers, gasoline stations, and restaurants. The outlook comes after the pandemic fueled 2 years of exceptional demand during the key holiday season. And of course, you think back, and what fueled that demand? Fiscal and monetary stimulus at unprecedented levels. So people had more money, they had low interest rates, and they could spend. Now what happens? They don't have the fiscal stimulus, they have higher prices, they have less income, and they have higher interest rates. All that should add up to is less spending. The trade group's outlook indicates a more challenging holiday ahead for retailers. A year ago, consumers shopped early and spent more to secure gifts as stores struggled to keep shelves stocked amid shipping delays. This year, however, major retailers, including Walmart and Nike, are swimming in extra inventory, and consumers are splurging less on items like clothing and electronics. As we get this, as I've said, they pay more for groceries and services like dining out and travel, more or less. They're paying more for rent. They're paying more for energy. They're paying more for food. I'll let you weigh in the comments. What are you paying a whole lot more for that you shouldn't be? And we'll see. My guess is it's falling in one of those three categories. And the question now is it true that high inflation leads to lower retail sales? It does, in a big way. Here you can see on this chart, we have in blue the consumer price index against advanced retail sales in red. And what you want to see here is every time there's a big run up in the blue line in inflation, what happens? Retail sales head lower. We see that again. Inflation head higher, retail sales comes down. We see it here. We see it again here in 2018. And guess what's going to happen again in the Retail Federation? Well, they know. There are still factors working in retail's favor. According to the chief economist, the consumers built up savings during the pandemic and the labor market is strong, which may make them feel secure enough to keep spending. Although with some of the recent layoff announcements, I have a hunch that that's going to change sentiment. But we keep hearing about this mythical pile of money that everybody happens to sit on. And yet one thing that remains correct is the personal savings rate is at ridiculously low levels. Here we can see the personal savings rate down to 3.3, which is very low. This is a percentage of what's left over in a household's paycheck to actually invest. It's very low, suggesting that if there is a big pile of money, and I don't know that there is because I don't have any evidence to support it, I keep hearing about it. If that is true, what the personal savings rate is telling us, it's about to get drawn down. And as we've talked about in prior shows, the manufacturing sector leads the services sector. So as we head into the holiday season, we should be looking to see, is the services sector moving higher or lower? The frightening thing is heading down. Here we can look across the world. We notice in Spain, we look at the services PMI, or Purchasing Managers Index, and a 50 means unchanged. Here we see 49.7. So you see stall speed here in Spain. How about Italy at 46? You're practically in a recession now. At 45 is where you start to get recessionary data. And you look over at France, their stall speed as well, just a slight expansion over the prior month. But notice the trend is decelerating. How about in Germany? You got recessionary, near recessionary print at 46.5, broad Eurozone 48.6, again showing the services sector is slowing down. How about here in the US? Well, came in at 54.4, but again, a deceleration. Is growing at a slower pace than last month at 56.7. So it's not something we would want to see. We want to see this accelerating, but what is validating here is exactly what I said, is the manufacturing sector leads the service sector. As manufacturing head lower, we should see the services slow down and then eventually contract. And there's some warning signs in this report. Here you can see new orders growing at a slower rate, employment contracting from growing. So now you see a shift in services sector employment going into the holiday season. How about prices? They're increasing at a faster rate, not something consumers want. How about backlog of orders growing at a slower rate? So again, you're seeing backlog start to get worked through, not a good sign for continued inflation. How about export orders contracting from growing, but yet they keep maintaining that inventory sentiment remains low. And what I have a hunch this is all going to turn into, I'd love to get your feedback. I think the Fed blows this thing up. I think millions of people hit the unemployment line. Not something I want, but at least history shows if the Fed continues at this pace, in fact, I think it's too late. That's the outcome. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.